Between the summers of 2006 and 2012, the United States experienced one of the most severe housing declines since the Great Depression. This had far-reaching effects, causing a global recession that affected countries all over the world. While much attention has been given to the crash itself, little is said about the years leading up to it. This is the bubble era, a period where housing prices in the US steadily rose and then suddenly skyrocketed after 2002. Real estate became a hot commodity, with prices increasing daily, frustrating and confusing buyers. If all of this sounds familiar, it's because we are currently witnessing a similar pattern in the housing market. After the crash in 2012, prices gradually started to rise again. However, following the events of 2020, they have suddenly exploded. The majority of the public understands that this market is far from normal. It is a new bubble, entering its final stage, characterized by speculation, investment, and greed. Interestingly, prior to the last crash, there were warnings about the impending doom that would befall the housing market. It is often portrayed in movies that only a select few, like Warren Buffett, saw it coming. However, it turns out that many prominent investors and even regular people were aware that the market was a massive bubble waiting to burst. Warren Buffett, hailed as the world's greatest investor, was one of those people. During the 2006 Berkshire annual meeting, which was held around the peak of the last housing bubble, Warren Buffett was asked about residential real estate and whether he believed it was in a bubble. His response, which is eerily in this excerpt from the video Warren Buffett, "What's coming is worse than a housing crash." Warren Buffett discusses the dangers of speculative real estate investing and the potential for a market implosion. He emphasizes that regular people are not to blame for these risks. Rather, it is the investors who rely on extreme leverage and greed. Buffett points out that even in great localities, there have been instances in the past where property values swung dramatically, such as in New York. Buffett, who operates a residential brokerage business in multiple states, notes that there has been a slowdown in the real estate market across various locations. This slowdown is most pronounced in the hottest markets, particularly in the high-end segment where people buy properties for investment or speculation purposes, rather than for personal use. Buffett gives an example of individuals purchasing a house for $100,000, but mortgaging it for $270,000. As long as the value of the property remains around $250,000 and the owners have stable employment, they are unlikely to sell and lose money. However, when it comes to investment or speculation holdings, particularly in the form of condos, the market can experience significant fluctuations. Buffett compares this situation to day trading in the stock market, highlighting that it can come to a halt and then quickly bounce back. He emphasizes that the focus should be on the investors who have treated real estate as if it were the penny stock market, abusing leverage and engaging in flipping properties as if they were day trading on a computer. Buffett draws attention to the increase in investor activity over the last 2 years, leading to unprecedented numbers. He mentions that many of these investors are using funding methods that are not transparently reported, including risky and fraudulent loans. In contrast to the stock market's continuous trade and price updates, real estate transactions are typically based on a limited number of comparable sales, which further complicates the market dynamics. In summary, Warren Buffett's main point is that speculative real estate investors operating with excessive leverage and greed are driving the risks in the market. He argues that regular individuals should not be held responsible for these dangers. Buffett highlights the slowdown observed, the method of using recent home sales in the same neighborhood to determine the value of one's own home is highly unreliable and can result in significant misjudgments. This approach fails to consider the volatile nature of the real estate market, which can witness sudden and drastic shifts in both positive and negative directions. A few unfavorable sales in a particular area can quickly lead to a repricing of the entire neighborhood, causing real estate crashes to occur unexpectedly. Warren Buffett highlights that investors in real estate only require one buyer to purchase at their desired price. However, due to the ambiguous nature of real estate prices, there is always an element of uncertainty in the market. When the word gets out about a potential downfall, investors tend to scramble to sell their properties, leading to rapid price drops. This behavior was evident across various markets in 2007, such as Phoenix. In some instances, prices in Phoenix fell by more than 5% within a single month, resulting in a loss of $15,000 in value for a $300,000 house within just 30 days. During the darker period of 2008, the decline in housing values worsened in Phoenix, with the average home losing 37% of its value between March 2008 and March 2009. It's important to note that this figure represents a metro-wide average, and specific neighborhoods experienced even more severe damage. In certain cases, homes lost over 60% of their value within a year, causing significant financial losses for the investors who purchased them. Warren Buffett argues that excessive lending to individuals driven by, in the speech titled, "Warren Buffett, What's Coming is Worse Than a Housing Crash," Warren Buffett discusses the alarming trend of investors obtaining loans to purchase struggling Airbnb properties, money-losing flips, and negative cash flow rentals. This situation echoes the same story that played out during the housing crash. During the Berkshire Conference, both Warren Buffett and Munger were questioned about these lending conditions and their predictable outcomes. Warren Buffett acknowledges that the issues that plagued the manufactured housing finance industry a few years ago have shifted to the financing of stick-built houses. He notices a concerning amount of excessive credit being extended in the American housing market, and he believes that this will likely lead to trouble in the stick-built sector in due course. Buffett asserts that foolish lending always has severe consequences, often on a large scale. These consequences may not immediately become apparent, as the effects of irresponsible lending can take time to manifest themselves, likening it to a disease with a delayed onset. He warns that by the time such consequences become evident, they may have already reached epidemic proportions. In the realm of foolish financing, we witness the repercussions that unfold. This trend appears periodically, and we have certainly seen it in the realm of commercial financing during the 1980s, with the emergence of the RTC and the savings and loan crisis. The underlying cause was the issuance of loans for ill-conceived projects, one after another. Developers were willing to embark on any venture that could secure financing. It's a straightforward equation. If lending institutions supply the money, construction will commence. Now, looking at the current scenario, we observe a striking similarity to the housing bubble that emerged in the early 2000s. While the circumstances may not necessarily align exactly with the past, as the saying goes, history doesn't repeat itself, but it often echoes similar patterns. The housing market's extreme fluctuations, which we have witnessed in recent years, have been fueled by bad loans and speculative investors in various hotspots across the country. However, this inflated condition will eventually collapse, potentially leading to an abrupt and tumultuous downfall. As previously noted, housing crashes rarely occur gradually. Rather, the market tends to turn suddenly. This roller coaster ride can be immensely frustrating, especially during the prolonged climb to the peak. The higher the gains, the more we tend to believe that the subsequent descent will,